What if I told you that in 2008, the entire global financial system almost vanished overnight, and that the seeds of this near apocalypse were planted in the one place most people feel safest, their own homes? Before we dive in, please remember that this video is for educational purposes only and is not financial advice. My goal is to help you understand these concepts so you can make your own informed decisions. With that said, in this video, we are going to unravel the story of the 2008 financial crisis. I will provide a clear framework that simplifies how a housing boom turned into a global meltdown. By the end, you'll understand what happened, why it happened, and the timeless lessons it teaches us about risk. Make sure you stay for the final part, where I'll cover the single most important takeaway for any investor today. Our story begins in the early 2000s. To understand the housing boom, we first have to look at what came before it. The dot-com bubble had just burst, and the 9/11 attacks had shaken the economy. To prevent a deep recession, the US Federal Reserve, led by Alan Greenspan, slashed interest rates, making it incredibly cheap to borrow money. This flood of cheap money had to go somewhere, and it poured into the US housing market. A powerful belief took hold across the country. Real estate is the safest investment you can make. Prices, it was said, only go up. This created a psychological frenzy. People saw their neighbors' homes double in value and felt like they were missing out. There was a wealth effect. As home values rose on paper, people felt richer and spent more, further fueling the economy. Everyone wanted a piece of the action, from ordinary families looking for a place to live, to real estate flippers buying multiple properties to sell for a quick buck. And the banks? They were more than happy to lend the money. After all, lending for a house seemed like the safest bet in the world. Who defaults on their own home? And even if they did, the bank could just sell the house for more than the loan was worth, because prices were always rising. It seemed completely risk-free. The demand for these home loans, called mortgages, was so high that banks eventually started running out of good borrowers, people with stable jobs, good credit scores, and a down payment. But the machine had to keep running. The solution? Lower the standards. This gave rise to the infamous subprime mortgage. These were loans given to people who normally wouldn't qualify. People with poor credit history, unstable income, and sometimes no proof of income at all. These were often called ninja loans, no income, no job, or assets. An entire industry of mortgage brokers emerged, whose only job was to sign people up. They worked on commission, meaning they got paid for every loan they originated, regardless of whether it was a good or bad loan. Their incentive was volume, not quality. Many of these subprime loans had a deceptive structure, like the 228 adjustable rate mortgage. Home buyers were offered a very low, affordable teaser interest rate for the first 2 years. But after those 2 years, the rate would explode, jumping to a much higher, often unaffordable, variable rate. For millions of families, it was a ticking time bomb. But in the heat of the housing boom, few paid attention to the fine print. The floodgates were opened, pushing house prices to astronomical heights. Now here is where a problem in the US housing market went global. The banks that made these loans didn't want to hold on to these risky mortgages. They adopted an originate and distribute model. The real money, they figured, was in packaging them up and selling them off. So they took thousands of individual home loans, some good, some okay, and many, many bad subprime loans, and bundled them together into a giant financial smoothie. This smoothie was called a mortgage-backed security, or MBS. They then sold this MBS to big investors, pension funds, city governments, and other banks all over the world. But how do you sell a smoothie filled with risky ingredients? You get an official inspector to say it's safe. That's where the credit rating agencies came in. Companies like Moody's and Standard & Poor's. Their job was to rate the safety of these financial products. But there was a massive conflict of interest. They were paid by the very banks whose products they were rating. To win business, they gave out top ratings like candy. So, these bundles of risky subprime mortgages were stamped with a AAA rating, the highest rating possible, making them appear as safe as government bonds. Wall Street then went a step further into madness. They took the riskiest, leftover slices from many different MBS smoothies, blended them together again, and created an even more complex and toxic product called a collateralized debt obligation, or CDO. Through this bizarre financial alchemy, these were also often stamped with that same safe AAA rating. And to top it all off, Wall Street created a way to bet on whether these products would fail, called a credit default swap. This was essentially an insurance policy. The giant insurance company AIG sold hundreds of billions of dollars worth of these insurance policies on the CDOs, believing they would never have to pay out. This created a hidden, interconnected web of risk, where the failure of one product could trigger a chain reaction across the entire global system. It was a giant, fragile house of cards. And that assumption that house prices only go up is what made this house of cards so incredibly fragile. By the way, if you're finding this breakdown valuable and you appreciate this clear, in-depth approach, a quick click of the subscribe button below is the best way to let me know. It helps this channel continue to create helpful content just like this. Now, let's move on to the moment everything came crashing down. By 2007, the ticking time bombs in those 2-28 mortgages started to go off. The low introductory rates expired, and monthly payments for homeowners suddenly skyrocketed. Faced with payments they could no longer afford, millions of people began to default. Foreclosures swept across the nation. Suddenly, the market was flooded with homes for sale, but there were far fewer buyers. Supply overwhelmed demand. And for the first time in almost a decade, the unthinkable happened. House prices started to fall. This was the single pin that popped the entire bubble. When house prices fell, homeowners owed more on their mortgage than their house was actually worth. Many just walked away. This meant the mortgages inside those mortgage-backed securities and CDOs were becoming worthless. That financial smoothie that Wall Street sold to the world, it was now poison. The big investors and banks holding these products suddenly realized they were sitting on trillions of dollars of toxic garbage. Panic set in. The value of these assets was plummeting, but because they were so complex, no one knew exactly how much they were worth or who was exposed. A wave of fear and paranoia washed over the financial world. Major investment banks, titans of Wall Street, like Bear Stearns, began to collapse and needed emergency bailouts. Then, on September 15, 2008, the government let one fail. Lehman Brothers, a 158-year-old institution, declared bankruptcy. It was the largest bankruptcy in U.S. history, and it shattered the illusion that some banks were too big to fail. Panic went nuclear. The credit markets, The system that allows banks to lend money to each other overnight to cover their daily business froze solid. Banks, terrified of who might fail next, stopped lending to anyone. This wasn't just a Wall Street problem. This meant businesses couldn't get loans to make payroll. Global trade seized up. There was a real fear that people would go to an ATM and find no cash in it. The entire financial system, the very bloodstream of the global economy, was having a massive heart attack. The Great Recession had begun. So we've covered how a simple housing boom, fueled by risky subprime lending and predatory practices, was amplified by Wall Street's financial engineering, blessed by conflicted credit agencies, and ultimately collapsed the global economy. As you can see, these ideas all work together to show how greed, complexity, and a fundamental failure to understand risk can lead to disaster. The key takeaways are clear. Incentives drive behavior. Complexity is often used to hide risk. And when one asset class is seen as a sure thing, it's often the most dangerous time to invest. The crisis wasn't just about numbers. It was about millions of ordinary people losing their homes, their jobs, and their life savings. To make this practical, here is your one assignment. This week, look at one of your own investments, whether it's a stock, a fund, or even your retirement plan. Ask yourself this simple question: can I explain in one sentence what this is and why I own it? If you can't, your task is to find out. Don't invest in things you don't understand. I encourage you to share your thoughts in the comments section below. If this is the kind of practical, detailed analysis that you find valuable, and you want to continue understanding how the world of finance really works, the best way to support this channel and see future content is to subscribe. We break down complex topics to make finance simple. To do that, just click the subscribe button right below this video and be sure to turn on notifications. Thank you for your time and attention today, and I look forward to seeing you again.